And welcome. My name is David Walsh, the president of Canopy Strategic Partners, formerly known as Zoo Advisors. This is I believe, our second webinar under the Canopy name. So excited to continue our webinar series under Canopy, but going to share some really interesting information here, really talking about the data of what happened over the last 3 years during the pandemic. It's, I think, fascinating information to kind of look back over what we all know has been a roller coaster. A pretty big down to begin with, some ups and maybe some downs here. And as I looked at the news this morning, some curves of we don't know where this is going over the next 6 to 12 months, but we will explore that. I'm joined by several of my colleagues, Zach Winfield, who will be giving the presentation and really going deep into the data. Paul Noland, who has been working with us in an of counsel role, going to offer some perspectives, and Eric Rose, joining from Hershon Family Entertainment, also going to provide some perspectives here as we launch into this. But the information we're going to share is a larger part of our audience analytics platform and a lot of the data work that we do here at Canopy. This just gives you a kind of peek into the type of information that we have and have been working with to provide these insights. And I think one of the key things that we're going to try to help do is not only kind of take this look back, but how we might use this information as we move forward. So with that, I'm going to pass the baton over to Zach, who is going to share this. I guess the one thing I do want to say before I hand it over to Zach, that we did share this presentation first time with the AZA directors at the Baltimore conference. So happy to share it with a much larger audience here, and then happy to answer questions as we go. But Zach?
All right, thank you, David. Hello to everyone. I'm Zachary Winfield, Vice President at Canopy Strategic Partners. And if you've worked with us, really at any point throughout the last decade, one thing that you know about us is that we are just, downright obsessed with numbers and data. So today, I want to tell you guys a story centered around some numbers. And as you can see here, we're calling this story What Just Happened, because I'm sure many of you are familiar with that feeling of just having come through, some sort of intense experience and having this sort of like a brain fog that just obscures whatever just happened to you. And I think to some extent, we probably all feel that way about the last, I don't know, 24, 30, 36, 48 months. I've lost track of time. It's been quite a ride. So the story I want to tell is the story of what happened in this profession kind of before, during, and after the pandemic. I use that term after loosely because who knows where we are or if this is indeed over. Obviously it is not. And we want to tell the story through the lens of numbers, right? And specifically through the lens of how attendance morphed and changed over the past few years. So what we've done is we've gathered attendance data for 206 US-based AZA member organizations. That's attendance for each and every month from January 2017 through, roughly today. And you may be wondering how we got this information, because I certainly did not go out and ask each and every one of you for it, although, in the past that might have been our only option to do so. But what we've actually done, like David mentioned, is we've used our new audience analytics platform through which we are tracking in real time, basically real time, a panel that includes tens of millions of mobile devices all over the country. And we've geofenced the locations of each of these 206 AZA organizations. And we've captured data about who entered each of those sites and when, right? And this capacity is really incredibly robust. we can learn, not just how many people were there, but where they live, where they work out, where they eat, where they shop, how much they earn, how they identify ethnically and racially, how long they spend on site, and like a million other little things. So there's really tremendous depth. But in this case today, we're not going for depth. We're not trying to be deep. We want to be wide. So we're looking at the high level attendance behavior only. So that is my preamble, and this is the story on how 206 AZA members fared through, I think, what we can fairly call one of the most tumultuous periods in history. And this is Act 1, or, if we're going to stretch this metaphor just a little bit further, it's probably better to call this the prelude, right? This is where everything was headed before the dam broke. The blue line is aquariums and the green line is zoos, and each of these dots represents the monthly average of attendance to each of those segments between January 2017 and the end of December 2019, right? A couple of observations right off the top. The first is that average aquarium attendance is higher than average zoo attendance, which basically just means that the aquarium set is more top heavy than the zoo set. Or another way to say that is that they are just compositionally more, way more actually small zoos than there are small aquariums. The second is that in terms of monthly average, aquarium attendance was trending up during this period, while zoo attendance was trending ever so slightly down. But generally speaking, what we see is this pretty predictable pattern that we've all come to know and love. Spikes in the spring and summer, a little bump around the holidays. Like, these are just the attendance patterns that if you were to extend this chart 20 years off to the left, it would probably look exactly the same writ large. This is Act 2, right? This is the fall, this is the plunge. And we all remember, obviously, all too well what those first few months of spring of 2020 were like, and really the entire calendar year. But I wanted to show this chart just so we can all visualize, like, really just how big of a plunge this actually was, right? How much was lost in terms of basically an entire spring and then most of a summer and holiday season. Like, this represents a complete shattering of that pattern, that familiar pattern that we'd come to previously, rely on. And of course, it didn't end in 2020, right? And we'll get to that part in a few minutes. But the big question, exactly how much loss are we talking about here? How many visitors didn't we host in 2020? If we were all in a room together, when I do this presentation in person, I ask people to guess. That obviously doesn't make much sense here in a Zoom panel, but I'm going to tell you. Based on all this data, we assess that in 2020 alone, right, before even factoring in the sort of up and down recovery period that followed, right, just in 2020, this profession lost over 25 million aquarium visitors and 44 million zoo visitors over the previous year. So that is right there already just a hair below 70 million people. And when you add back in all the non-zoos and aquariums, right, all the safari parks and aviaries and life science museums and all these other odds and ends AZA members, that number grows to 93 million lost visitors, right? So just for some context, about 165 million people visited these 200 some odd organizations in 2019. So this is a loss of over 50% in a calendar year. It's actually about 56%. So that is field trips, education programs, opportunities to connect with wildlife, to spend quality time with friends and family, and of course, not to mention just a metric boatload of revenue, poof, gone, incinerated. So, this is kind of Act 2. It's starting to feel a little bit like a tragedy, but like all good stories, Act 3 is the turn. It's the recovery. And this is what that looked like. We have zoos on the top and aquariums on the bottom. The blue line in each of these is the monthly average for 2017 through 2019. And the green line is January 21 through June 2022. And the cool thing about this is that you can almost pinpoint like the exact moment in both cases when visitors, they came back, right? They felt safe or some version of safe. or maybe they decided that they'd had enough quarantine. For zoos, it was in July of 21, and for aquariums, that moment came interestingly earlier. It was in May. And as you can see, those lines, the blue lines and the green lines, they essentially converge. And the second half of 2021, all the way through the first half of 2022, was basically a return to those familiar old attendance patterns. So, nice, tidy little recovery we got going on here. But so far, everything we've looked at has been almost entirely in aggregate, right? We know from our work with many, many of you here on this webinar that, the pandemic and the recovery and everything in between, it wasn't neatly distributed. It was messy. And, even beyond that, this is an industry that basically resists a lot of aggregation. So we wanted to take a look at how a few various subsegments throughout our 206 organizations fared. And to do that, we had to define a few things, right? We talked sort of generically about these time periods, but I want to specifically detail them here for the back half of our talk. When I refer to the pre-pandemic period, what I mean by that is January 2017 through December 2019. When I say the pandemic period, that's Q1 2020 through Q2 2021, right? So 6 quarters. And the quote unquote recovery period, we're calling Q3 21 through the end of Q2 22. And of course, we are now here deep into Q4 of 2022, but this analysis took quite a long time, so we had to kind of draw the line somewhere. And at the very end of the slide deck here, we'll take a quick sneak peek at what's been happening more recently. Then there's these other two terms, right? Pandemic quotient, recovery quotient, which I've defined here really for people who may download these slides later so they know what they're looking at. But basically, the pandemic quotient, you can understand that as a quantification of how hard an organization was hit during the pandemic. And the recovery quotient defines how strongly visitors returned after the height of the pandemic. So first thing we want to do is take a quick look at how these metrics correlated. This is a scatter plot of all 206 organizations. When I do this talk for an individual zoo or aquarium, like I'll color their dot in red because they always want to see where they are. Couldn't do that for all of you here today. But basically, the further right they are on this chart on the x-axis, the better they did during the pandemic relative to their pre-pandemic period. And then the further up, the further north they are on the y-axis, the better they did during the recovery. And, I kind of hemmed and hawed about whether to include this because really the only thing that's interesting about this chart is that it's like not interesting in the slightest. It is exactly what you might expect. And it's really the only part of this analysis that came out exactly as we expected, right? If your visitors continued to patronize you during the heat of the pandemic, if for whatever reason COVID did not hugely affect their behavior, then of course that is also going to be true in the recovery period. Next, we asked ourselves, was there some geographic correlation about how various organizational segments recovered, right? Was there something about a site's physical location that was predictive or maybe even causal? So we distributed these organizations according to the US Census Division. And as you can see here, there are 9 of them. So you can take a second here and just locate yourself on this map. And what did we find? We found that basically there was no good geographic correlation, at least, not at this level. Nothing about proximities between census divisions was useful in the slightest. For example, organizations in the New England Census Division, which is all the way on the left side of this chart here, they had the strongest overall recovery quotient. At the same time, those of you in the Atlantic Division, which, physically in the real world directly abuts New England, those organizations in the Atlantic region are all the way on the other side, all the way on the right, meaning they had the weakest overall recovery. So, at first blush, not too much here. This was, maybe a little bit disappointing, but we learned, I always like to say we learn just as much when our hypotheses turn out to be wrong as when they're right. So we'll chalk this up as a win anyway. Next, we moved on to market size. We wanted to know if there was a correlation between how many people live in your markets and how well you recovered, how many people live there and how dense they are. And here we find that we're finally getting somewhere, right? We actually did find a pretty strong, almost remarkably strong correlation, right? We used MSA boundaries for this. And in case you're not familiar, an MSA stands for Metropolitan Statistical Area. And you can kind of loosely understand that to be a general aggregation of like municipalities surrounding a major economic hub. So that would be like, Philly in the suburbs or Chicago in the suburbs. And we use those MSA boundaries to calculate population bases, and then we distribute them by quartile. So these organizations on the left side of the chart, they're in the first quartile. Those are your smallest populations, the least densely populated. And in most cases, they are geographically distant from other major metro areas. And those organizations have the strongest recoveries. And as you move to the right, you start to get into larger and larger markets. And as you can see here, the recovery gets weaker and weaker as you go. So it's this very tidy little correlation, right? Even if you control for zoos versus aquariums, which we've done here in blue and green. So it's interesting. It's hard to say that, this is conclusively causal, but it is definitely extremely, extremely well correlated. Next, we wanted to know if there was some correlation between income, right? The earning status of your residents in aggregate and their recovery. And for that purpose, we chose median disposable income, which is different than median household income in that it controls for cost of living, which obviously is going to be very different in different types, different flavors of metros. And again, we found that there was a correlation, right? It wasn't quite as striking as it was with market size, but it's clearly there. The lower earning quartiles, the first and second quartile on the left, they recovered much more strongly than the higher earning quartiles, the third and fourth quartile on the right. Next, we asked ourselves about diversity, right? Was there a correlation between diversity status of a market and their recovery periods? And, your first reaction to this might be that there are, that large markets are in aggregate going to be more diverse than smaller ones. And that is true to a certain extent. But interestingly, the data doesn't actually bear that out as quite as much as you might think. There are quite a few small markets with relatively high composites of diverse populations and plenty of big markets that are less diverse than you'd guess. But when we look here at this data, we come back to what is now starting to look like pretty familiar. We have less diverse areas on the left, and moving over towards the right, we have higher and higher proportions of diverse populations. And as you can see, the organizations in less diverse markets tended to have stronger recoveries than those in more diverse areas. The last thing we looked at, and I'm only including this because this totally blew my mind, is the correlation between health status and recovery. And when we started looking at this data, I thought for sure, 100%, markets with higher proportions of sicker people are going to be more likely to stay home. They're going to want to stay safe. They're going to want to minimize their risk. But what do you know? That was not the case at all. It was actually 100% the flip of that assumption, right? On the left side of our chart are markets with lower incidences of major health issues, right? These are things like cardiovascular disease, obesity, renal disease, diabetes, cancer, respiratory disease, all sorts of nasty stuff. And as we move to the right, those are higher incidences, right? Actually, these are much higher. The fourth quartile has about 70% higher incidence rate than the first. And what we saw here, what we observed, is that in those markets, which are relatively less healthy overall, more sick people, not only was the recovery much stronger, right? That's the green bar here, but their actual performance during the height of the pandemic was also much higher, right? So just to be like real clear, what we're seeing here is that sicker populations were more likely to patronize their local AZA organizations than their healthier counterparts. And I don't know what this says about Americans, but, we got to say something. So I guess you could kind of infer that for populations who maybe weren't all that concerned with their health before COVID, right? They sure as heck are not going to let a pesky little, once in a generation, deadly global pandemic stop them from getting on with their day. So this was very interesting and super surprising for me. So like I said at the beginning, this work took time to get ready and we had to draw a cutoff at the end of June 2022 for our data collection period. But in the interim, We've been hearing from lots of our clients and friends around the industry that attendance has been sort of soft since then. And that they are seeing declines, year over year in visitation pretty much across the board. So we wanted to take what we're hearing, right? This is anecdotal, and we wanted to test it. And what do you know? 3/4 of these AZA organizations that we were testing, 3/4 of these 206 organizations were down in attendance during July and August versus the previous year. And this was basically true across all segments in terms of different organization types, right? Aquariums, zoos, wildlife parks. Almost everyone was off during the summer. So this is 22 over 21. We also compared these same months to over 2019, which is of course the last pre-pandemic summer. And it's a really similar picture. It's not quite as dramatic. I think 68 or 69% of them were also down. So definitely softer. So we are super curious, as I'm sure all of you are, and I think we're going to talk a little bit more about this later, what the future holds, what's in the crystal ball, what the post-recovery and the ongoing post-recovery period starts to look like. We are watching. A few last sort of takeaways to wrap things up. The first thing I want to do is give a little bit of dap to my smaller organizations. Those of you in sort of mid-sized, smaller markets, a lot of the media and all the buzz always goes to the big shops. But like we saw in the data, it was, kind of generally speaking, it was the smaller markets that recovered more quickly and more strongly. And you guys provided a much needed oasis, right? You were an outlet for constituents when they very, very much needed something to smile about. Second is this thing about the why zoos and aquariums matter research. I'm sure, a lot of you industry folks here are familiar with that research. I remember when I first came into this profession, this industry 15 years ago or so, my boss sent me to my first AZA conference, and one of the first sessions I sat in on was a session about this research, about why zoos and aquariums matter. And I was super struck by the finding that the number one reason people go to zoos and aquariums is not to see animals, but it's to spend quality time with their families. And if I put myself back in that same headspace of like the first 6 to 9 months of the pandemic, when like so much of the peripheral stuff about life, like all the after school activities and the birthday parties and the travel, when all that was totally stripped away, for better or worse, all I had was my family. And I think a lot of other people had that experience too. And all of you, all these AZA members, you were there to give us something to do, to be together, to do something positive, constructive, and educational. And it was a reason to smile again, and we all really needed one. Third is this next question about like, what is the ceiling for this profession, right? I don't want to be glib, but despite all the challenges of the pandemic, right, a lot of AZA member organizations were perfectly set up to succeed in the aftermath, especially during that recovery. People weren't traveling as much, so they were looking for something to do, and they were looking for something to do outside and to do with their families. And you were there, you were open, and you were there, right? It was almost the ideal circumstance to be in the zoological profession. But despite all of that, in aggregate, the industry basically just sort of got back to where it was before. So I think that begs an interesting question, which is, what is it exactly is the ceiling for how many visitors we can hope to bring through our gates? Lastly is I guess, we'll take it the State of the Union way. The state of the industry, I think, is strong. You can't not be impressed about the resilience of the profession. The pandemic was not equally kind to all sectors, right? I actually read a few weeks ago, a while back, that Six Flags, during this period, they laid off 25% of their staff nationally. They have no current plans to bring them back. I think it was 110,000 restaurants closed. They laid off 2.5 million people, incinerated $250 billion in economic activity. But among AZA members, we didn't lose a single organization. And it's not like this is an industry that's swimming in cash, right? It is extremely difficult to make ends meet, let alone turn a profit, especially when profit is not your primary motive. So the fact that every single AZA member organization made it through the other side, I think really says a lot. We have made it through what was, inshallah, God willing, hopefully the worst of it. And you're looking to now what's ahead and trying to figure out how to continue to do that critically important mission work that you all do. So that is basically my story for today, and I'm going to turn it back over to David and the rest of our panel to continue this conversation. Thank you for your time. David, you're muted. Rookie mistake.
Rookie mistake, not used to this webinar. Thanks, Zach, for that. Really great and in-depth numbers. You've given this talk now a couple of times and have been immersed in this data, not just this data, but lots of data, working with lots of different clients. What was your biggest surprise as you looked at all of those numbers?
My biggest surprise, I think, was just like the big shocking number about how many visitors were lost. I think, as far as I know, I might be wrong, but I think we're the first people to try to put a number exactly on how many visitors were lost during 2020. And that is just an absolute staggering number of people. 93 million is a crazy number of people. That, and obviously the thing about sick people coming out to zoos more readily and earlier than their healthier counterparts was a huge surprise for me.
Sure. And you've given this talk not only at the directors conference, but then with a number of individual zoos and aquariums. What have you been hearing in those more individual conversations about the data and about what you uncovered?
I would say some mix of surprise and a little bit of discomfort about like the uncertainty of being kind of becoming suddenly untethered from like what was previously a super predictable attendance pattern year after year after year. Like everybody wants to know what's going to happen in the next 6 months, the next 12 months. Have we recovered? Are we still recovering? And I think we're all trying to figure that out. And I would say the other reaction that we've heard a lot is just that the fact that this level of data is now available, like, everybody's carrying around these tracking devices in their pockets now. We've been doing it for decades. And of course, this information was accessible to people with deep pockets. But like now, even for the humble cultural attractions nonprofit, we can tell you who's coming to the zoo, when they're coming, where they live. And I think that's a little bit surprising and of course, super useful for a lot of folks that we're working with.
Great. Thanks. I'm going to open it up to our other panelists here, Eric and Paul. And Eric, kind of your initial observations and reactions from the presentation and all of the data.
Yeah, thanks for having me. And this is actually the second time I got to hear this from Zach from the conference. So picked up a few additional things. I think first reaction, it's not overly surprising. You can dig into it a little bit and put some context to it, but I didn't see anything out there that really shook my head. In that, you had mentioned about the families coming together and so forth, about the togetherness, and that just coincidentally happens to be the mission of our company. But when you look at it from an economic standpoint, we're certainly are on a consolidated basis. Persian Family Entertainment, we have 26 properties across the United States, one in Canada. And the scatter plot where you put all of them on the trend line, that's a little bit like our company. And we look at it from a portfolio perspective of some are up and some are down, but on a consolidated basis, we all help each other out, just like our own mutual fund portfolios. So we're definitely off from 19, but we've been trending well above 2021 positively. And I think that's a factor of really a lot of it has to do with our geographic locations. We're smaller properties in an urban core. Or the bulk of our attendants, say Gatlinburg, a lot of people last year and this year escaping from the major cities and destinations. And so national parks were very popular. Secondary cities were very, very popular. Rural destinations were very popular. And that just played very, very well into our portfolio. But from an economic standpoint in our company, it's not just about the volume. If you look at our missions, whether you have a conservation mission and you're trying to get as many people through the turnstile as possible to experience your educational messaging and conservation messaging, or in our case, we're trying to bring families closer together. From an economics and business perspective, it goes back to yield management and per capita spend. So most businesses out there, restaurants, consumer goods, and then the factor of inflation and the cost basis, though we're off of 19 and we're trending ahead of 2021, our per capita expenditures are well above 30% over what they historical are. So it's really, in our portfolio, it's a yield game and it's a profitability game. Is we'll be more than willing to have less people come through our properties. Operationally, that helps us a whole lot to ease certain congestion, as long as the yields are there. And I hear very similar things from my aquarium colleagues in the industry, is whether they're doing dynamic pricing or different types of pricing strategies, there's a skew in the population base, and just people are used to the inflation prices bringing on, as well as the change in the demographics of our customers, skewing more to the higher household income levels.
Thanks, Eric. As a follow-up, did you see amongst your properties, did your aquariums do better than, say, theme parks, or was it kind of any differences that you saw amongst those 26 different properties?
Yeah, the ones that struggle a little bit. So we have to calculate in who deployed capital. It's comparing apples and apples. It's somebody deploys $2 or $3 million in new exhibits versus not. But where we really saw the softness were not in our premium brand. So even say Newport, Newport Aquarium is more of a premium brand attraction within the Cincinnati marketplace. Where we saw softness were in our brands that service more of a value-based customer versus a premium brand. So say Dollywood would be the ultimate example of the premium brand. But our properties that don't necessarily have that brand premium and serve a lower household economic base were the properties that were softer. And our belief is that with these inflation pressures, if somebody's in the 60 to 100,000 household income level, they just can't afford to go to the attractions like they used to with $7 eggs and $6 gas. Their discretionary income was all chewed up. Where individuals with that higher middle income, higher income, 125 and above, even though they're seeing inflationary pressures in their household, they certainly still have the cash reserves, whether it's savings or income, to go out and do these properties like they used to, and spend the dollars to do the premium.
Yep, great. Paul, turning it to you, you bring a bit of a broader perspective. You've worked in the attractions field for a long time. Any initial observations or reactions from looking at all of that, looking at the data and the trends there?
Yeah, it's incredibly good work. I think that, to me, the most surprising thing is that it's not surprising at all that zoos and aquariums have recovered and are, we're mostly getting back in the first half of this year back to 2019 levels. I actually would have expected that in the latter part of the pandemic period and then the recovery period, that they would have sort of outperformed where they were in 19, because you did see in the broader leisure markets where you had activities that were largely outdoors, families could enjoy together, and were local. Those kind of activities, during the pandemic, once they were open again and during the recovery period, actually outperformed where they were in 2019, because there weren't as many choices. You weren't going to movie theaters. There's a lot of things you weren't doing. So things like golf rounds, and I know this is a really weird collection, but things like golf rounds, fishing licenses, state park attendance, national park attendance, all those things kind of had a period where they outperformed because the choice set was reduced. So I actually would have expected them to do even better than they did. But it's great that they recovered as far as they have, but I would have thought there would have been at least a period of over or outperformance versus steady state. But other than that, it makes a lot of sense. I think a lot of what's going on also among leisure attractions, I think Eric mentioned it, is while when you look particularly at the big guys like the Disneys and the Cedar Fairs and the Six Flags of the world, most of them, their revenue is now above, not all of them, but most of them, their revenue is above 2019. So again, versus the amount of revenue they were driving before the pandemic, they're exceeding it. But but they're doing it very differently than before. I think that the pandemic gave people really a chance to think about, okay, what is our product and what are we offering? They also knew that their costs were going up very rapidly. On another webinar we did before, we talked about the fact that the labor rates in the hospitality, attraction, leisure space went up higher than any other labor rate increases in any other industry. So people are paying way more for labor, way more for things. So there has been this subtle shift towards what I call attendance being down on purpose. So a combination of getting rid of discounts, raising traditional pricing overall, reducing the number of operating days and not being open on days that aren't particularly profitable, things like that. They purposely push down attendance. It makes for a better experience, but that's also then, again, as Eric said, allowed them to push up their per caps, which generally has led to increased profitability. What I don't have a line on yet is kind of how the summer finished. All the public data that's out there is really through June. And so we really don't know how July, August, and September performed. Anecdotally, talking to some independent park owners, they had a good summer. They stayed strong all the way to the end. And most of them are either closed or in the process of closing for the season now. They still stayed pretty strong in that July, August, September timeframe.
Okay, great. Well, I have a couple questions that I want to throw to the panel about kind of what the future might hold, but I'd like to open it up for any questions that anybody in the audience has after the seeing and looking at this data. Anything, questions or comments or observations? And either speak out or raise your hand on Zoom. And I'd be interested to hear from any of the participants kind of how has this, the aggregate numbers, have they mirrored kind of what you have seen in your own institutions?
I have a comment. I'm out in Arizona, and my gut would tell me that outdoor attractions, zoos, would have recovered far faster than indoor attractions, and where aquariums, the admittance cost is generally higher than is with zoos. I would have expected that aquariums would not have recovered nearly as quickly. So I was a little bit surprised by what you've shown us this morning.
Yeah, I can give you my best hypothesis on why that was, because I was also surprised to see that, Richard. So it was, I believe in May, we saw sort of the aquarium group recover to the roughly the pre-pandemic numbers, which it was April, May. And if you kind of think about that and align that with where we were back in May 2021, April and May, that is the spring break season. So what we saw generally in sort of spring and summer 2021 was a lot of pent-up travel demand. And because so many of these aquariums are in locations with that are reliant on tourism, I think maybe they were the beneficiary of sort of that early spring break surge, right? The fact that they were indoors or outdoors was sort of irrelevant to a lot of people at that point. And they were just, they had the benefit of being located in places where people were traveling to because of all the pent-up demand. And so they caught the earlier edge of that wave. That's my best guess.
Okay, thanks.
Just reading the chat here. In terms of the difference of zoos being still quite crowded during peak COVID periods, but many zoos didn't stay closed to the public as long as those in low risk areas did. Zach, just goes, I think, back to the geography, a little bit to the geography question and kind of who opened earlier, any kind of other observations that you had from just looking at that geographic data, which you said, which by the numbers really didn't seem to match what you might have hypothesized, but
yeah, I mean, I think if we had gone deeper into geographies, right? The US Census regions are fairly broad. There's 9 of them that cover the whole country. And even within those census regions, you're going to get like a broad range of sort of, I don't know how to say this, but like kind of political leanings. So obviously, if there are places that have put artificial restraints on, public gatherings, that's of course going to be a tamper on attendance, and I'm sure that has a huge impact on these numbers. And unfortunately, there's not like a great data set for what the COVID restrictions in place were and when and where, but really great point.
Yeah, and then another question in terms of kind of impacts on membership and what happened with membership during that time. And obviously the data that we have, at least on the aggregate level, doesn't capture that. What I can say just anecdotally from a couple of the client projects we're working on now, we saw a huge increase in some member capture rates, and the membership definitely seemed to grow. I think the question, at least in my mind, is kind of, is that sustainable? Will those people that signed up and joined as members in 2021 stick around for all of 2022 and so on? Zach, you've also looked at a lot of those numbers. Any kind of membership related?
Yeah, so Kat, I see your comment in the chat there. I'm not sure what organization you're with or what your 2021 was like in terms of attendance. And the reason I ask that is because we find that the membership and attendance are very closely correlated. They tend to track each other very well. Oh, hi, Kat. So I didn't realize who I was talking to here. Santa Ana Zoo, right? So they're correlated. So when attendance goes up, membership tends to go up. Also, when attendance goes down, we also see membership going down. But particularly when there are artificial attendance spikes, that you will see growth in membership programs, but those in many cases tend to be sort of like fair weather or short time, membership / annual pass buyers, people who may have, bought it because the line was long and they wanted to skip the line that day, but they're not really your core customers. So I'm not surprised to see that come back down in 2021, but obviously an important thing to keep eyes on.
Great. And there's another question in the chat around that zoos and aquariums have traditionally relied on cost reduction versus investment. Is this the time to invest in new projects and innovation? And Eric, I'm going to toss that to you in terms of kind of what you saw, what you're thinking.
Well, as a property leader and marketer in me, I'd say it's always the time to do that, but there's a finance practicality to it as well. There's also, most of the things that we come out with don't happen in a couple of months. So I would say from a product perspective, I would always encourage any of the clients I work with or Hershend or anybody out there today, react to the short term, but don't lose sight of your strategies over the long term. Most of the capital projects we deal with are 1 to 5 years in development. And we certainly postponed. We put everything on hold during COVID because we didn't know what was going on. But as soon as we had even a glimmer of hope to the future, we reactivated our asset capital plans and started launching product from that. There's also the festival side of things that may not always be brick and mortar, but promotional festival opportunities, seasonality campaigns and so forth. I mean, consumers are still going to be driven by product, and that's what we see in our company as those properties that deployed good promotional opportunities, good product, are doing very, very well. And that's probably a universal truth, except for maybe those 6 months during the core of COVID. So my advocacy would follow your master plans you had before COVID and just, make course adjustments where needed. But you shouldn't be bashful in moving those forward.
Thanks, Eric. And our observations from working across the field with so many different clients is that investment has continued. We didn't see many projects stop completely, definitely slowed down at the start of the pandemic, but investments in new exhibits, investments in master planning. So everybody's a bit bullish, I think, in terms of making those investments, which I think is smart because as Eric said, it takes a while, you have to start planning, and so you don't want to get too far behind.
Now, I will add, David, if I could, one thing from reading the question a little bit more closely, projects and innovation, not just product, customer facing. We have greatly advanced our IT programs in pulling them forward, in that anything that will help with labor productivity is getting massively accelerated. We're looking, I'm sure I hear it in my aquarium circles, insurance claims, insurance rates are going through the roof. So we're deploying capital that would get us more favorable terms on our premiums and those type of things. So same thing is respond to what's happening in your organization with innovation, whether it's public facing or operational.
Great, thanks. So I'm going to kind of ask the $1 million question, is kind of what do you all see, our three panelists and speakers, as kind of what is the next 12 months, 12 to 18 months, pick your time horizon, hold, and kind of where do you think things are going? Eric, you want to take a stab at that one? I know it's the crystal ball, but let's all play the soothsayer.
Yeah, no crystal ball here, but I'll tell you what we're doing. Clearly something's going to happen. You have to be living under a rock not to think that we're going to see a softness. It's unprecedented. We have massive inflation in the United States, and that's primarily the driver behind the Fed rate increases and slowing things down. Inflation and labor being a big component of that. Europe's going to war, and everything going on over there with petroleum, utilities and things. And then China's still in lockdown from COVID and has a housing crisis, a real estate crisis. So, this is a global issue, but where does this mean back from home for us? We are preparing for some softness. All the economists and forecasts we're seeing, hopefully it's going to be this proverbial soft landing. It's not going to be an implosion like in the real estate bubbles and other recessions of the past. And so maybe it be a technical recession. It'll probably be a little bit softer. So we're putting our contingency plans in place for Q1, Q2, and watching our labor, holding open head count. We have promotional opportunities, contingencies in plan if we see a little bit of softness on the demand side of things, that we can launch some programs that would help drive some volume that we wouldn't normally otherwise do if the demand is there. And then deploy the tactics for a Q1, Q2 expense management plan. And if we see it, most likely it's not going to be a 1% contraction, and most likely it's not going to be a 5-6% fall off the cliff. It's just going to get a little tough for a while. But what I'm reading is there's still people want to get out. There's pent up demand. We may have chewed up a lot of the COVID monies that were put aside, but once we get past this kind of trough in Q1, Q2 next year and get into the summer, all things being equal, unless it's a prolonged landing and recovery, we should see a stronger, robust Q3 and Q4. That would be my prediction from everything I'm hearing internally into our company as well as externally.
Great, thanks. Paul, your thoughts on kind of where things are going?
Very cool.
Yeah, I think Eric's right. I agree with his direction. I was a little more optimistic until the last couple of weeks. I mean, like the new inflation report that just came out, mortgage rates have hit a 20-year high. That's going to absolutely take some wind out of the housing market sail. And so I think that the ability to avoid a recession and to just have a soft landing seems to be increasingly difficult to imagine that that's going to happen. I think we're definitely going to have some consequence to all this, but I kind of agree with Eric. I think by Q3, Q4 next year, we could see some recovery, because a lot of the fundamentals are still good. I mean, the economy got overheated, not only here but abroad. Our economies got overheated in an attempt to be proactive and deal with the pandemic downturn. And the reality is economies got overheated. When economies get overheated, you got inflation. But there's zero sign that inflation is abating yet. And that's, I think, what's probably the most concerning thing on the horizon, but it can, the brakes started to be applied a few months ago. And so if you think about another 6 or 8 months, that might be enough that we could then start to see some real turnaround, I hope.
Great. Zach, what does your crystal ball look like?
Yeah, I'm gonna take a little bit of a different slant on this answer. I think it's important to differentiate between the different types of organizations, especially within AZA, right? If I were a small to medium-sized organization, I would be, especially community supported with public support, public financial support. I'd be feeling a little bit more bullish about a return, some sort of regression to the mean behavior that looked more like pre-pandemic behavior. But, if I'm a big zoo or a big aquarium in a big city with huge financial burdens and maybe less public support, more reliant on tourism, more expensive to get in, more expensive to experience, I certainly would be feeling a little bit more nervous in the way that Eric and Paul described.
Any learnings that that the group, the participants can take away, looking back over the last 3 years, how can organizations kind of use that kind of data looking back to help them better predict the future, not just, maybe what the next 6 to 12 months have, but even beyond that? Zach, I'll start with you.
I think nothing has changed about the fundamentals of economics. I think looking at how your organization has performed, looking for those constants in your economic model, about how people buy and spend on site, like how changes to pricing strategy affect the bottom line. That stuff, it was true 4 years ago and 10 years ago, and it'll be true for the next 5 years. The big question, of course, zoos and aquariums, visitors are their lifeblood, and that's the big question mark right now. That's one we tried to answer, and I think being conservative about it, especially over the next 6 to 18 months, is the way to look at it. But again, just sticking to the fundamentals and relying on what you know from the past.
And Eric, any thoughts that you have, kind of as you've, what can we all learn from the last
I would say it's the new normal. So some of our organizations are better at this than others, but get into your data and insights and analytics, and that not all guests are created equal. And Zach, I agree with what you said about your crystal ball for the future, and really understand who your guests are and what segments you have, from household income to education to travel behavior. Are you a bunch of stroller moms coming from 5 miles away, or do you cater to tourists extensively? And really understand that. And then your organization needs to have the speed to respond to that. You can't be looking at your reports in June and make a decision for next Christmas or next year. You need to be responding in a very, very quick behavior pattern. Who's coming, who's not coming, and how do you manage accordingly?
Right. Paul, any last thoughts that you'd like to share before we wrap up?
Yeah, I would add that I do think that, while I hate the word unprecedented, I try not to use it anymore because it got so overused over the last couple of years. But I do think that things are evolving and changing so quickly that we need to be really responsive. And while historically you can look at the past 3 years and do rolling averages and go forward, and you can get a pretty good plumb line on where your demand's going. I just think those rules are out the window for the next. Well, they've been out the window for the last few months, and I think they're going to be out the window for the last year. So the ability to dive deep on who your customer is going to continue to be critical, as Eric said. And then also having a variety, don't wait till you know what the problem is to start solving it, start sort of scenario planning now, so that when you figure that out, you can pull, you already know what triggers you're going to pull based on where costs are going or where demand's going or how your segmentation is changing, and that you're kind of ready to go.
Great. Eric, I do have one last question that I think you probably best answer, in terms of you mentioned it about kind of the per caps in revenue. And I've been reading about, Disney pricing and driving that higher revenue.
Yeah.
Do you think that can continue? We seem to be stripping every last dollar out of the guest.
Well, let me pull out my other crystal ball. I'll let you know. So I think I think it continued to a degree. I think, you know, we raised price, all of us have raised prices in some form or another. We didn't do it in a vacuum. That was more of a general trend in the economy. If we were doing it as an attraction where without, you know, price increases across the board, I think there would have been a lot more sensitivity to it. Clearly, theoretically, there's a threshold. You get to a certain point where you're going to have erosion. But the flip side of that is looking at, you know, I'll go back to my statement of looking at your different customer segments, is the customers that can afford to pay that and have that togetherness with the family. I look at my family, you know, I'll pay a pretty penny just to get my family together. That's one audience. But then have those promotional opportunities for those individuals that maybe get priced out, to have those promotional opportunities to be able to service those customers. It's not like we're ignoring them. We're just getting a lot more robust in understanding those distinct segments and servicing those segments. And I think a trend in the last few years we see a lot in our zoo aquarium world is dynamic pricing, working with the various vendors out there. You know, we used to always have analog, peak, non-peak, promotional seasons and so forth. And dynamic is taking it to a whole level of sophistication. And there are, you know, maximums that you're going to be able to hit. And we're just got to watch it as we do price increases. We put mechanisms in place to watch that demand fall off. And if we do see a demand fall off, we have contingencies in place to put some promotional opportunities to buy it down. But, you know, I'll remind for those folks who don't know, Hirsch and Family Entertainment is a for-profit business. So, you know, we approach things with a very commercial mindset to it and have the infrastructure to do that. But they're not overly sophisticated. I would encourage every organization to drive your mission, but still try to drive your bottom line at the same time.
Right. Yeah, balancing the mission and the margin piece.
Yeah, totally.
Trying to do. Well, thank you, Eric. Thanks, Paul and Zach. Thanks for the great presentation and great work. We will be sharing more on the presentation in our next newsletter. So appreciate everybody joining us today. And look forward to seeing you on a future session. Have a great afternoon.
Thank
Thanks
you.
again all.